From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, January 26th. Here are the top market stories we are following for you at this hour. Decision day, the Federal Reserve gets set to signal its first rate hike since 2018. March liftoff is baked in, but investors are looking for clues on the fate of the balance sheet. The cloud to the rescue. Microsoft shares swing from losses to gains on an optimistic growth outlook for its Azure cloud business. Tesla, the next tech titan to report after the bell today. And a rebound for now. After two volatile days of trading and a drop to the lowest level since June of last year, the Nasdaq 100 is leading a bounce back for U.S. stocks. The question, will it stick? From New York, I'm Kaylee Lyons with Guy Johnson in London. Alix Steel is off today. Welcome to Bloomberg Markets. And Guy, just about 4 hours to go until we get that Fed decision. What is that going to mean for this equity market?
I think we're all going to keep a careful eye on what is happening. But I think in some ways the main event is happening right now. And that's the news that we get out of the Bank of Canada, which has decided to leave rates on hold, despite the fact that the Bank of Canada is saying that economic slack is now, quote, essentially absorbed. It's slightly lowered its GDP forecast to 4.6 in 2021, 4% in 2022, 3.5 in 2023. Inflation forecasts higher, sees 4.2% average in 2022. I think we're at circa 4.8 right now. So certainly a slowdown there. But the main headline is that we do not have a rate hike. The market had expected a rate hike. Economists had thought that we would see a story of what we've got, basically, which is a hold. But the Bank of Canada removing its exceptional forward guidance and basically saying slack has been absorbed, but we're going to keep the benchmark overnight rate at 25 bips. So let's talk about this a little bit, because in some ways this was going to be the second major G7 central bank to hike rates. And if they had, I think maybe that would have stolen a little bit of thunder from the Fed. Mike McKee joining us now, Bloomberg's international economics and policy correspondent, to give us his take on this. Mike, a surprise?
I don't think so. A majority of economists thought they might hold, but a significant minority were predicting a rate increase. I think they're kind of in the same situation as the Fed. They're trying to condition the markets for a rate move going forward. They do, in their monetary policy statement, raise their forecast for inflation. So they're acknowledging there is an issue out there. It may be they don't want to get too far ahead of the Fed because, of course, the interest rate differential could hurt the loonie and their efforts to provide growth in Canada. So not a surprise, but I don't think it probably just means that it's coming soon.
And Guy, this, of course, Bank of Canada is coming on Federal Reserve Day, and that actually is our question of the day, whether the Fed is facing a big problem given the volatility in the equity market we have seen. But Ira, it really has been confined to the large part in the equity market, the volatility of the last week or so. Do you think the Fed has a problem here if the rates market is relatively calm?
Well, it's not so much that the rate market is calm. I think that the Fed's problem now is, do they think that they're behind the curve? And do they think that because of their actions that the market will price for significantly slower growth in 2023? And I think that repricing of risk assets is something that they're going to have to acknowledge today, that certainly Jay Powell in the press conference is going to have to acknowledge. I will say something about the Bank of Canada decision, because, even though economists thought that the Bank of Canada was going to wait this meeting, the market was pricing for about a 70% chance of a hike today. So you've seen actually the loonie actually start to come off a little bit on the back of this decision. So the markets were kind of prepared. Now, the way that I read some of the headlines, and I haven't read the full report yet, obviously, it's rather lengthy, is that the Bank of Canada might still move before the Federal Reserve because they have another meeting prior to the March 16th meeting by the Fed.
Ira, do you think, coming back to the question, do you think that the Bank of Canada in any way has reacted to the recent volatility we've seen in markets? It's not just been confined to the United States. This has been a global phenomenon. Or do you think there's something else at play here? Why did they decide not to go this time is the background of what we're seeing on our screens on a day-by-day basis going to be a factor?
I think it's just, hey, why don't we wait a month? We'll just prepare everyone. The language that you mentioned earlier, Guy, about them saying that basically the slack is essentially gone from the labor market. That's the kind of information I think they wanted to convey. So, to Mike's point, the economists weren't expecting it. So I think they were maybe looking at what the economists were thinking for this meeting as opposed to anything else. But we're still going to be priced for another hike. And I think the challenge that central banks are going to have is not so much when do we lift off, but it's what's the pace, and then what ultimately is the terminal rate. So how high do interest rates get this cycle? And for most markets, they're not thinking that they're going to hike more than six-ish times in the terms of the Bank of Canada and the Federal Reserve this time.
All right, Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence, thank you so much for joining us. And of course, remember to tune in to Bloomberg's special coverage of the Fed Decides. That starts today at 1:30 p.m. New York time. And Guy, of course, it's a very interesting picture we're looking here as we look ahead to the Federal Reserve, but also for the outlook for fiscal policy here in the U.S.
So fiscal policy absolutely front and center in all of this as we think about what's going to happen with Build Back Better. We've got a meeting taking place with CEOs. They're going to be talking about that today. So that's a factor that we need to bear in mind when we think about what is going to be coming out of this administration. So let's talk more about that and figure out what is going to be happening here. We need to now go to Washington, D.C. We have the Commerce Secretary standing by. We welcome our TV and radio listeners. And we welcome, of course, Bloomberg's Joe Matthew, because we are joined now by Gina Raimondo. She is the U.S. Secretary of Commerce. Joe, take it away.
Thank you. Indeed, we are joined by the Secretary of Commerce, Gina Raimondo. Madam Secretary, thanks for being with us once again on Bloomberg. As we consider the chip shortage, it's somewhere we'd like to start at this moment in steps that the administration is taking to loosen this up. We've talked a lot about it. Before we get into the next phase of this, I'd like to just set the baseline with you for our conversation. The White House was out with a report yesterday showing that this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
Good morning. It's always good to be with you guys, and thank you for having me. I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. Yeah. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
It brings us to one of the big steps you're taking, a legislative solution, the Competition and Innovation Act. That's made its way through the Senate. There's the House version was released last night. It's a massive bill. A lot of us tried to get through some of the thousands of pages that are in there. But once this dropped from Speaker Pelosi's office, we heard real pushback from Republican leadership in the House. Representative Michael McCall, the ranking member on Foreign Affairs, said Democrats decided to torpedo any chance for a bipartisan bill. Is he wrong?
I think that's an unfair characterization. Speaker Pelosi worked incredibly hard with her team, with the chairs in a bipartisan way to put together, as you say, a 2,000 plus page competition proposal. Let me say this, there is broad bipartisan agreement. A bill very similar to what came out in the House was passed at the end of last year in the Senate with 19 Republican votes and, nearly every Democrat. So to my mind, this is very reminiscent of the bipartisan infrastructure plan, which the president signed last year. There is broad bipartisan agreement that we have a national security crisis on our hands if we don't increase the domestic production of chips. Right now, we make no leading edge, the most sophisticated chips in the United States of America. We purchase nearly all of them from Taiwan. Congress cannot sit on their hands and refuse to take action on that. And I've talked to many Republicans, including McCall, as recently as last week, who assure me they fundamentally support the goal and vision of the bill. So what has to happen is pass the bill, let's get to conference, and let's hash it out. There will be disagreements. The one thing I will predict to you is that the bill, which is the president ultimately signs, will not look exactly like the bill that came, proposed last night. So, let's get together. The bones are bipartisan. Let's get to a conference. This is a good starting point. And let's solve the problems that right now Americans are facing.
Time being of the essence here. So let's try and get a timeline for when it will clear the bill, when it will clear the House. When do you think that's going to happen? When do you think we'll actually start to be able to take action? We obviously had the news over the last few days about the plant that Intel is going to be building in Ohio, but that's a long way off. Madam Secretary, how quickly can we resolve this problem in the United States?
Well, as you say, these things take time. I was in Ohio on Friday. Intel made a $20 billion investment in what will be the biggest semiconductor fab in the country, if not the world. But here's what they also said. They could go from 20 billion to 100 billion in the next handful of years in America, if and when the CHIPS Act is passed. So we have no time to waste. We hope that the bill goes on the House floor next week. We hope for a swift passage, and then we get to conference. And we have to move quickly. I cannot emphasize it enough. The chips we need go into the most sophisticated military equipment. This is about our competition with China. This is about creating jobs. This is about fundamentally shoring up America's economic competitiveness and national security competitiveness.
Let's get into the national security aspect of this, Secretary, if we could for a moment. We hear a lot about that. We hear that line a lot. So what does it mean as we hear talk of war on the other side of the world, the standoff with Russia, Ukraine? What is the U.S. doing to stockpile enough chips to take care of our defense?
Of course, we do stockpiling. But again, you can only stockpile so much. We need to make this in America. And by the way, I've spoken with probably 50 members of Congress since January 1st. Democrats, Republicans, many Republicans, they agree. The only solution is to make more chips in America. Purchasing 60, 70% of the most sophisticated chips from Taiwan is a vulnerability that is obvious. It's staring us in the face. Mm-hmm. And the bills before Congress are the solution. So I understand Republicans don't like every aspect of what the speaker put out last night. So then do your job. Solve these problems, find compromise, and get the bill to the president.
Madam Secretary, are we in danger of weaponizing the chips industry? Is that what is happening here? The Washington Post was talking last week about the fact that the administration is looking at the foreign direct production rule to use against Russia to restrict access to the chips industry, to the most sophisticated chips that are out there, even some of the less sophisticated chips. Is that what is happening here?
So I obviously am not in a position and will not comment specifically on specific tactics and strategies that we may use vis-a-vis Ukraine and Russia. But the president has been very clear that the United States, with our allies, is preparing a range of very severe economic measures to impose on Russia if it further invades Ukraine. And I will say, it's not weaponizing semiconductors, but the fact of the matter is semiconductors are a vital component of every piece of technology, including military equipment.
Madam Secretary, we will watch with interest. We'll watch certainly what is happening in the House and watch the progress of the chip bill as it works its way through. We look forward to seeing some results there. The U.S. Secretary of Commerce, Gina Raimondo, thank you very much indeed. Our great thanks as well to Bloomberg's Joe Matthew. And be sure to tune in to Joe's Sound On. That is on Bloomberg Radio, weekdays at 5 p.m. in New York. Okay. Let's move on, get some reaction to what we've just heard and look ahead to the Fed and think about the implications of what we heard from the Bank of Canada as well. Jan Hatzius, Goldman Sachs, chief economist, joining us now. Jan, can I just start actually and think a little bit about what is happening with the economy? We just talked to the Commerce Secretary about what is happening with the supply bottlenecks that we're seeing in the semiconductor sector. How much of a problem is that going to be as an ongoing issue that we need to think about in terms of the inflation narrative, the inflationary narrative that is currently working its way through the U.S. economy?
I do think it's still going to be a factor that is important for the price level as we go through 2022. There doesn't seem to be a quick solution. So I do expect that prices in a number of goods producing sectors, and especially ones that rely on semiconductors, are going to continue to be high. With that said, inflation is about the rate of change of prices. And so I think the goods producing sector is going to go from, up very sharply on a year-on-year basis to much more stable a year from now. The question around inflation is really more in terms of how much of an acceleration you get on the services side and how tight the labor market is and what that means for wages. So there are definitely some clear risks, upside risks to the expectation that inflation comes back down to something, 2.5% to 3%, which is basically the Fed's view. But I don't think it's as much about goods, and it's really more about services and the labor market.
Well, let's talk about how the U.S. consumer factors into this as well, Jan. I want to point to a tweet from Claudia Sahm, who is over at the Jane Family Institute, previous economist at the White House and at the Federal Reserve. And she says the Fed is not going to have to do as much as the markets think because Congress is doing its best to slam people. The child tax credit was putting $200 billion at an annual rate in the hands of parents in December, zero in January, also letting COVID run wild. And Jan, I know that the child tax credit and the lack of a fiscal impulse this year played into your downgrade in a forecast for U.S. growth. How do you square those two things where we're talking about potentially less consumption, consumers maybe having a little more price intolerance, and also a Federal Reserve that you think could hike at every meeting from March in theory?
Well, there are a lot of moving parts in the growth outlook, and I would certainly agree that fiscal policy is going to be a drag on growth in the short term, basically because the amount of support is being stepped down. No more tax rebates, no more extended unemployment benefits, and probably no more expanded child tax credit. So that is going to be a drag. On the other hand, there still is a significant amount of recovery that we can see from post-pandemic sort of normalization, especially in the service sector of the economy. And that's been on hold a little bit in the very near term because of Omicron, but we do think that that's still going to be a factor. So where we come out is that the economy is still going to grow somewhat above trend in 2022. And in an environment where many labor market indicators are quite close to full employment, the Fed's probably going to want to slow things down to more of a trend pace. And I think that's still going to require higher interest rates. So we have 4 hikes in 2022, which is consistent with market pricing. But the risks are potentially that they would have to do more. And we think, even on our baseline, that as you go into 2023, 24, we'll see additional rate hikes.
You've got terminal rates at 2.5%, 2.75%. How quickly do you think we get there? You talk about the 4 hikes this year. Presumably we'll have to have more next year because we'll only get to circa 1% this year. Is that going to be enough to get to the point that you're talking about? Where is neutral, do you think, Jan, in terms of where the Fed is likely to get to and kind of think about what is happening in the economy?
Yeah, neutral is always difficult to estimate, of course, and there are a number of estimates out there. The Fed's estimate is 2.5% in nominal terms, or 0.5% in real terms, and we have a similar estimate. So, I think there's a reasonable case that maybe you go a little bit beyond that if the labor market continues to improve and inflation is still somewhat above the longer-term 2% target, which is our expectation. But it's obviously going to depend on the data. There's not going to be a sort of preset plan to get to a particular level, nor should there be. The Fed will need to respond to the incoming information on the economy and on financial conditions.
And when we look at that incoming information, is it going to be wages that is critically important, Jan? And do you think we are either on the precipice or already in a wage price spiral?
Well, I think wages are definitely an important issue for the inflation outlook, as we discussed. I think the question is, what do wages tell us about, where output and employment are relative to potential? We've seen some very rapid wage increases in the last couple of quarters on a sequential basis, quarter on quarter annualized. Our estimate is that that's between 5 and 6. That's been between 5 and 6%. But there are also, I think, some reasons to believe that maybe some of this is more temporary because of one-off retention bonuses and things like that. Until the end of the summer, you still have the expanded unemployment benefits, which we think had an impact on wage growth at the bottom end of the pay scale. So some of these things, I think, are going to be normalizing. We should see in our forecast somewhat slower sequential wage growth as we go through this year. But I think it's one of the key questions over the next 6 to 12 months.
Yeah, and the phrase I hear the most at the moment is threading the needle. Everybody talks about the Fed threading the needle. Do you think the Fed is going to have to choose ultimately, and I think this is relevant to what you just said about wages, do you think the Fed is ultimately going to have to choose between tackling inflation and growth? And which side do you think they're going to come down on? Do you think they're going to be prepared to tolerate a little higher inflation just to maintain the growth level, to try and keep people employed and see wages going higher? Where do you think the balancing act lies? And do you think the Fed is going to be able to, now that Hackney phrased again, thread the needle?
I do think it's, threading the needle. I think that's a reasonable way to look at it. They have a dual mandate on both inflation and employment. And so they're going to want to put some weight on both. They would like to bring growth down to more of a trend pace and thereby, stabilize measures of labor market slack before you get clearly past full employment. And I think that's going to be the goal. I don't think we're necessarily so far away from that. I don't think we need a very aggressive tightening of policy to get to more of a trend growth pace, especially if financial conditions, continue to tighten. We've seen some tightening in financial conditions, hasn't been very big so far, but I think that is ultimately probably necessary to see a slowdown to more of a sustainable growth pace.
Well, Jan, I'm glad you brought up the tightening of financial conditions, because our question of the day today is if the volatility we've seen in the stock market, the sell-off we have seen, creates a problem for the Fed. Do you think it makes their job easier or harder down the line?
I think it is what usually happens when you see a change in direction on monetary policy. I mean, a few weeks ago, I think you would have said it's been surprising how little impact we've seen on the equity market from the shift in the near-term monetary policy outlook. So now we've had obviously some very volatile days, and you wouldn't say that anymore. But I would still say that overall financial conditions, while tighter than they were 4 weeks ago, still haven't tightened, so much that the Fed would want to abandon the idea of a March rate hike, for example. We're not close to that, in my view.
Yeah, and can you just give me your thoughts on how we should think about hikes versus balance sheet runoff? And it's not one for one, and I don't know how you should think about it, but can you just explain your thinking around how you're trying to work out this problem about what effect runoff is going to have and how does that compare with rate hikes and what the Fed is going to be thinking about around this issue?
So our expectation is that they are going to rely predominantly on rate hikes for normalizing financial conditions and the stance of policy, and the balance sheet runoff occurs in the background and is much less responsive to new information about the inflation outlook or the growth outlook. So it's not quite autopilot, because of course, if there are large changes, then the balance sheet policy could be revised as well. But we don't think that's nearly as activist. We also think, based on our estimates of the translation of balance sheet size or asset holdings into financial conditions, we don't think there's going to be a very large impact from the balance sheet adjustment. The most of the impact on financial conditions, based on our estimates and the academic literature that has looked at QE and its impacts, really says that it's more interest rates and the policy rate and the funds rate.
Jan, we only have about a minute left, but market pricing already has come quite far in terms of expectations for future Fed policy. What do you think would be the biggest hawkish surprise that the Fed could deliver today?
Yeah, I wouldn't expect necessarily large hawkish surprises here. I mean, in theory, they could say we're stopping QE right here. That's something that has been talked about. They're still currently signaling to go and end only in March. They could do that, but we don't expect them to do that, just based on what we've heard from FOMC members. Chair Powell in his confirmation hearings, for example, was asked about the QE program, and he said it would end in March. So it would be a surprise, but I would not expect that. I think, otherwise the tone of how they talk about the inflation outlook, obviously it's going to be important, and there's always going to be something for the hawks and the doves. But I wouldn't expect a very disruptive type of communication. They're trying to get ready for the normalization.
All right. Jan, unfortunately, we have to leave it there, but thank you so much for your valuable insight on this Fed Day. Jan Hatzius, Goldman Sachs chief economist, appreciate your time. Of course, in addition to monetary policy, we are watching geopolitics, and the U.S. is now urging Americans in Ukraine to consider departing now. We are seeing stocks off of session highs, still up 1.8% on the NASDAQ. This is Bloomberg. We're about an hour into the U.S. trading session. Stocks are rallying, and Bloomberg's Abigail Doolittle is tracking the moves. Abigail, I got to be honest, I don't know if I trust a rally after the action we've seen over the last couple days. Is there a sign this one might stick?
Well, your point is well taken, because there has been so much volatility. Who knows how we'll end up? But there may be some signs here that we could see these gains for stocks stick. We have the S&P 500 up more than 1%, the best day of the year. The same deal for the NASDAQ 100, outperformance up there, up 1.8%, also the best day of 2022. Now, encouraging signs in terms of the possibility that maybe these gains will stay around. We do have that VIX coming in right now below 30, and bonds about flat. This is, of course, going to depend on the Fed, but you have that 10-year yield back at 177. Anything above 170 suggests that yields are probably likely to go higher. So if Haven bonds are selling off, that would support maybe the idea that stocks will continue higher. The other big deal here, of course, is earnings. If we take a look at Microsoft, we are going to see that shares are higher. Now, of course, in the pre-market, or the after hours, I should say, yesterday, initially there was a sell-off because even though they put up $50 billion worth of revenue for the first time, the cloud growth was slow, but forecasting big growth for the cloud, helping the stock go higher. Tesla reports today after the bell. They'll have to put up a blowout quarter, some analysts are saying, to support the valuation. And then perhaps the biggest of them, Apple, reporting tomorrow. Today, really helping those markets, up 1.1%. Let's see how that quarter comes in. And this company also getting a nice little piece of news from China around the iPhone being the top smartphone in the fourth quarter. As for Microsoft, last week we were talking about sell the dips. This chart makes a very strong case for sell the rips, and not buy the dips and sell the rips. You could probably do both here. But what we're looking at is a one-year chart. In blue, we're looking at the 50-day moving average. Technicians love looking at the slope of the moving average. As you can see, that 50-day moving average, the near-term buyers, the strength of the dip buyers, it is starting to dip down. You can also see that Microsoft has been trading in a trend of lower highs. That makes a very strong case for sell the rips. There is a reason to think there will be a rip to sell, because you can see the RSI climbing back up. So we could very likely see Microsoft climb back toward the top of that range. But unless it makes an all-time high, a new high guy, this chart suggests that there's a near-term rally ahead for Microsoft, but there could be a pretty bearish fall at some point later this year.
It's all about timing. Tough to do. Abigail, thank you very much. Abigail Doolittle on what is happening with the tech sector. Let's continue the discussion and talk more about the earnings that we're getting. Mark Lehman, JMP Securities CEO, joining us now. JMP specializes in investing in technology. He is the perfect person to talk to. Mark, let's talk a little bit about the big picture story, first of all. Then we'll dig into the earnings. It's been a really tough start to the year for big tech. Is this an opportunity for investors? Do you want to put money to work in this sector right now? What do you make of the price action?
Well, it has been, and the end of the year was exactly like the beginning of the year, which was difficult, especially for the high growth, high multiple stocks. And that's not been tempered by some of the action in the first few weeks of the year. I think we saw some stocks really get much lower than I think even some of the most bearish people expected the stocks to go. And that's what happens in these kind of violent rallies and violent contractions in stocks. I think the VIX is telling you that we're going to have more days like this. And I think you're also going to get an opportunities. I mean, Microsoft, frankly, is a perfect example of that, right? It's the most understood stock, let's call it that, as one of the highest, if not the highest market cap company in the world. And that stock's traded in a 10% range from the lows of aftermarket trading last night to right now. Think about that, 10% range for the most well-understood stock. That's problematic, I think, for the market in general, which is we want these to be a little more tempered. And days like yesterday and the last week are showing that we're probably have more days ahead. But I think, again, the valuation umbrella for some of these stocks is intact. I think there's lots of capital on the sidelines. And I'm not talking about, people's investing and they're going to put a few bucks to work. Yeah. We haven't talked about private equity. We haven't talked about some of the people who swoop in here when valuations contract. And I think there's lots of that potentially on the sidelines. We just haven't seen that yet, which gives me confidence that the year is going to be just fine.
Well, but talking about kind of that valuation contraction, Mark, already the NASDAQ 100 is trading at a multiple of about 25 times, the lowest since May of 2020. That's still 30% above the 10-year average. How much further do you think we could see that multiple contraction?
I think the opportunity for the overall market to contract is high. What I also think is some of the less valued company, the lower valuation companies probably get a second look. And the companies that have been trading, frankly, at market caps to revenue that are infinite, because, again, profits are farther down the road, those will contract. We're going to see kind of the lower valuation companies, I think, go higher and some of the highest valuations stay lower. And that's a good backdrop for the overall market. It's never a good sign, in my opinion, when there's a small band of stocks that are doing extremely well and the overall market's doing poorly. Even before the last couple of weeks, half of the NASDAQ was down 50% from its high. It was hidden by the fact that the FANGs, I call it Mount FANG because I include Microsoft and Tesla, but it was hidden by the fact that those stocks held up until a couple of weeks ago. I think this is cathartic for the market, but these things take time and everybody likes a quick fix. There's no quick fix here.
What's the read across from Microsoft? Let's talk about that now in terms of the details on the earnings. What's the read across from Microsoft into the rest of the sector, Mark?
I think the read across is that the health of the economy and the health of technology is real. They're as good a proxy about corporate America, like you said, about cloud and some spend. It's healthy. The economy is getting better. And yes, we have this Omicron weight that's probably going to lift in the next 6 weeks. I thought the Pfizer CEO's comments were portended a much better back to work and back to normal marketplace. And that's going to happen through the rest of the year. We have so many more weapons that we're going to have to combat Omicron and get the supply chain intact. That's going to happen as the year progresses. That means that I think rates will start to dissipate, or the fear of rate rises will start to dissipate. The health of the economy will continue. The health of the global economy will continue. And I think that's great for the overall read. And Microsoft is as good a lens on that. And again, their report was just fine and their outlook was just fine. That's what was, I think, more important than anything than the printed number, because that's in the rearview mirror.
But on those outlooks, how good is good enough for some of these really richly valued tech stocks? How high is that bar?
It's really high. I mean, if you love the stock at 100 times revenues, why do you love it now that it's at 60 or 50 times revenues and profits are in the rear, or not even in the rearview mirror? They're not even in the mirror right now. That's the question for the market. And I think the richly valued, the profitless companies are getting repriced. But what I'm seeing from the investors that we talk to and some of the funds that we talk to is that they're ready if these corrections stay permanent, to put more capital to work. Yep. And frankly, I don't think we've seen that yet. Okay, I have walked and talked with a lot of portfolio managers over the last few weeks. I felt no fear from these people. In fact, I always say the market's getting close to a bottom when my mother calls me and says, "Are you okay?" Okay. So she called on Monday and she said, "Are you okay?" That kind of put a bottom into the market. These portfolio managers are ready. They're doing the work that they need to do if these stocks take another leg down. Because again, the fundamentals of the economy, what's changing the economy, the digitization, the fintech companies, some of the other things that we've talked about in the show have not changed one iota, despite some of the multiple compression that we've seen.
Another market indicator we now have to look for, Mark's mother, and when she phones. Let's talk a little bit about some of those companies that you talked about having the potential to go down here. Microsoft has just stepped up to the plate on the M&A front. It is tricky for large tech companies to do that right now. Nevertheless, Cathie Wood talks about innovation being sort of on sale right now. Is there a potential for some of these big companies with a lot of cash, with a lot of potential to generate cash, to do some consolidation here? Can they go shopping?
They will. I mean, these are the most richly valued companies with the most cash on their balance sheet. And like you said, we saw a company get acquired for cash recently. I'm getting old enough where 2016 seems like a long time ago, but there was a time of year, this time of year in 2016, we called it Tableau LinkedIn Friday. Okay, both companies missed earnings substantially on those days. Stocks went down 30, 40%. The SaaS stocks went down 30 or 40%. And guess what? Microsoft stepped in then and bought LinkedIn. Tableau got purchased then too. Okay. I think we're going to set ourselves up potentially for that backdrop. That drawdown that time of year was more substantial than we've seen today. But the innovation is probably more substantial today. So obviously it hasn't happened yet. We've seen the rebound. The NASDAQ is up 10% or so off the bottom from the lows of Friday. We will see that. Okay, because innovation never dies. And I think there's lots of opportunity for these big companies to buy these broken angels if that happens. And I think they're assembling their list. And that example of that acquisition is a perfect one for what we saw recently.
Innovation never dies. I'm going to get that printed on a T-shirt. Thank you so much to Mark Lehman, JMP Securities CEO, which, of course, is a Citizens company. We do want to get to some breaking news for the oil market now. We just got the EIA inventory data. Crude oil inventory is up 2.38 million barrels last week. That is far larger build than the estimate for just 1 million barrels. Interestingly, though, you are still seeing crude climbing right around 2 session highs. On WTI, we're north of $87 a barrel. And on Brent crude, the global benchmark, we just got a little taste of 90 right now at 89.87. But the gains continuing for the oil market in this risk on day. And of course, when you're making a shift to EVs, you don't need oil so much, but Ford is investing in an electric truck startup, Rivian. It's now worth more than $8 billion. And we'll hear from Ford CEO Jim Farley on how long the automaker will hold on to that stake before it cashes out. Stay tuned for that conversation. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta, and you're looking at a live shot of the principal room. Coming up, Scott Miner, the Guggenheim CIO, at 2 p.m. New York time, 7 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Rishika Gupta. The Federal Reserve's in the spotlight today. At the end of their 2-day meeting, policymakers are expected to signal plans to raise interest rates for the first time since 2018. That rate hike is not likely to happen until March. The Fed's trying to contain the highest inflation in 4 decades. President Biden has ramped up the effort to deter Russia from war. He says he would consider personally sanctioning Vladimir Putin if the Russian leader orders an invasion of Ukraine. President Biden has already threatened some of the most severe economic penalties the U.S. and its allies can muster if Ukraine is invaded. And OPEC and its allies are expected to stick to their plan and ratify another modest production increase next week. The 23-nation coalition will probably rubber stamp a hike of 400,000 barrels a day for March. Oil is trading at close to a 7-year high. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, Ford CEO Jim Farley is one of 10 business leaders who will join President Joe Biden today to discuss the stalled-out big Build Back Better economic package. Earlier, though, he sat down with Bloomberg's Emily Chang to discuss Ford's finances and what he intends to do with their stake in electric truck startup Rivian that's now worth more than $8 billion. Take a listen.
Well, it's been a great investment, and we really like RJ. We really like what he's doing. The fact of the matter is we're both in the almost same segments. And so, we'll work through that. We really have always seen this as strategic investment. So there's a lot of possibilities that we could do with Rivian beyond just building a vehicle together. I won't go any further than that.
So no plans to sell?
No.
Just now?
No. But, we'll look at everything. Everything's on the table. Our lockup period ends in the middle of May.
And do you see cross-shopping between the...
Not yet. Not yet. The Maverick isn't, our F-150 Lightning isn't out yet. They're just scaling up, so it's early days. I don't expect us to be in the same cross-shopping in early days. F-150 Lightning, RJ and I talked about this, is very different than their truck. It's much smaller. Theirs is really for a lifestyle off-road. Ours is really kind of a work truck, a working person's vehicle. E-Transit is very different than their Amazon van. So in the early days here, as the brands build out, I don't really see us being cross-shopped initially, but we are in the same segments.
Jim Farley. Really interesting conversation. You want to hear more of it? It's coming up a little bit later right here on Bloomberg. Bloomberg Technology today, 5 p.m. New York time, is where you will find it. Let's talk more about this story. Let's look ahead to what is happening with Tesla, which reports a little bit later on. Ed Ludlow joining us now from San Francisco. Ed, let's talk a little bit about Rivian, first of all, and then kind of migrate our way towards Tesla. Rivian Ford, that's a really interesting combination. The F-150 Lightning is going to be a huge product for Ford.
Yes.
You've obviously got Rivian in terms of a potential competitor to that. How would Rivian do if Ford was no longer a partner, if they actually saw Rivian as a competitor?
Yeah, it's a really good question. You have to remember that Ford made that kind of initial $500 million investment in Rivian at a time where their EV strategy wasn't as focused as it is present day. The Mach-E hadn't yet been really revealed. They hadn't revealed the F-150 Lightning. Their production strategy, their investment commitment wasn't clear. So this was them kind of hedging their bets a little bit on an upstart that was not really upstarted yet, hadn't started production. I've reported, along with Keith Norton here at Bloomberg News, that Rivian kind of relies on Ford a bit more than Ford perhaps relies on Rivian. Ford has helped Rivian get set up with its stamping presses, for example, in the factory in Normal, Illinois. But clearly, Ford's stake has taken off, and it represents a really nice, healthy return for the company. But Farley seemed really transparent to me in that video clip, right? He's saying, we're kind of competing against each other. I call it like frenemies.
I think that's an accurate description, Ed. And while we're talking about competition, it's not just Ford and Rivian. There's a ton of players in this space. And of course, the dominant one is Tesla. And when it comes to trucks specifically, are we going to get some more information about when we're expecting to see a Cybertruck today?
Yeah. I think that's what the Tesla fans want to know, right? Tesla's such an interesting company to cover. You have the big institutional investors that hold the stock partly because they track the S&P 500, right? But the retail investor, which is also a Tesla vehicle owner or Tesla fan, is so present. And they want to know about this stuff, the product roadmap. You'll remember that Elon Musk kind of made this big splash about not wanting to be on earnings calls anymore because it wasn't a great use of his time. But then he turned around and said, well, actually, this quarter I'm going to participate because I want to set out the product roadmap. Cybertruck's really key to that. It's so anticipated. Pickup trucks are big in the US. But there's so many other big ticket items. And I think you guys have the data. But I ran this Twitter poll. And what surprised me is how much interest there is in the status of the new factories in Austin, Texas, and in Berlin in Germany.
Yeah, because that's going to have the biggest impact in terms of production. This is a company that needs to ramp up production. It's efficient. It is doing well, but we need more. And I'm wondering what could kind of hold that story back. And I thought it was a really interesting poll that those that took part focused on this. When do those plants start to really get into gear, if you can get into gear with an electric vehicle? And are semiconductors going to be an issue in terms of getting that production online?
Yeah, and this is interesting in the context of earnings season and the moves we've seen in major indices, right? Because they had a strong fourth quarter of deliveries, 300,000 vehicles, well above expectations. That is almost a leading indicator for sales growth, right? The street sees 46% top-line growth for Tesla throughout full year 2022. But if we've learned one thing from the early days of this earnings season, it's that beating the top and bottom line in any given quarter, that's not really the focus. What the street wants to see is a strong outlook. And how many vehicles come out of Austin and how many come out of Berlin this year is a big part of that. I think the consensus model is for 1.3 million vehicles Tesla delivers this year. But again, the ramp is a big part of that. We know for Tesla, ramps were painful in Fremont, California, but very successful in Shanghai. And then in ramping in Berlin, for example, Guy, in Europe, you can get a Tesla in the UK right now, but it's built in Fremont or it's built in Shanghai. And a big part of the course growth strategy for Tesla has been building vehicles in the markets where they're due to be delivered. And there's a lot of excitement about that because you might see sort of deeper penetration in Europe where Tesla faces more competition from the European legacy players, which we don't even talk about in the US, right? Like Peugeot, Renault, they have real models in the real world on real streets, and Tesla has to combat that.
All right. Thank you so much to Bloomberg's Ed Ludlow. We'll look out for those results after the bell today. Right now, in the cash session, Tesla shares are up about 2.6%. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. AT&T posted fourth quarter earnings that were better than expected. That gives investors less reason to be concerned about the cost of lavish free phone promotions and 5G and fiber network expansion. AT&T had already announced that its subscriber growth in 2021 was the fastest in 10 years. And the controversial cryptocurrency project that Mark Zuckerberg once defended in front of Congress is unraveling. The reason? Regulatory pressure. The Fed was uneasy with the crypto initiative, now known as the DM Association. It's now weighing a sale of its assets to return capital to its investor members. And a new survey finds that most global finance firms are planning to establish or expand operations in the UK this year. That comes from the professional services firm EY. It's a boost for the City of London. Its credentials as an international finance centre have been questioned since the UK left the European Union. And that is your latest business flash. Guy, Kaylee?
Ritika, thank you very much indeed. Kaylee, long have people talked about the idea that we're going to see the City of London suffering as a result of Brexit. There's that word. You have seen some evidence of it. So a number of big American firms have moved out of the city, moved trading, etc., over to places like Paris and Amsterdam. But we're not seeing the destruction that maybe a lot of people had anticipated. And it's going to be interesting to see ultimately whether or not the ECB and other regulatory bodies in Europe push back on that.
Yeah, and I wonder how much this is just a case of the post-Brexit UK picture evolving over time, because when EY initially did this survey in 2019, only 11% of firms wanted to build up a presence in London. It was 50% in early 2021. So this is a significant shift, and I wonder if it comes as it's being seen that the UK is actually more stable post-Brexit than maybe initially thought.
Yeah, I think if you take a look at the politics in the UK, I think stability wouldn't be the first word that comes to mind. But we'll see how that develops over the next few days. Talking of that, let's talk about where we are with the markets right now. The pound actually not on the move today. There was some speculation that maybe we get the Sue Gray report into Boris Johnson's parties today. Maybe we don't get that today, but the pound certainly is stable right now, barely budging. The stock 600, though, is definitely on the front foot. We have seen a re-rating this year, but today we are bouncing back really quite strongly. And one of the reasons for that is the energy sectors on top. Brent crude, as Kaylee was bringing us a little bit earlier on, touching 90 just a few moments ago. We're trading at 89.98 right now, so we're kind of flirting with that 90 level. That is a reason why European stocks certainly on the front foot. Stephen Englander, global head of G10 FX research at Standard Chartered, joining us next as we count you down to the Fed. This is Bloomberg.